Hello, this is Jordan, and this video is being recorded on Tuesday, July 26, 2022. Thank you so much for joining me today. In this video, I'm going to talk a little bit more about secular trends in gold and stocks and how it relates to gold. In the last video, I was discussing the potential fate of the stock market and how if it were to roll over and go lower later this year, that would more than likely confirm that the stock market has entered into a new secular bear market. And if you only can hear one or two things in this video, that is it. And the second thing is gold and gold stocks historically, their best moves on a long-term and also a cyclical basis, we're just talking about a couple years to 3 or 4 or 5 years, they're best during periods when U.S. stocks are in a secular bear market. So I only have one chart today for this video. There's a lot to go through in this chart, but we have the U.S. dollar index at the top, then we have the S&P in the middle. Below that, we have the gold to S&P 500 ratio, and then at the very bottom, we have expected returns based on a 60-40 portfolio. The 60% is based on an indicator from Professor Robert Shiller using what's known as excess Cape yield. And the 40% is based on the current yield on the 10-year Treasury. So that's a 60-40 right there. And the 60%, the excess Cape yield from Robert Shiller, it does adjust, or it tries to adjust for when interest rates are really low. So you could say it's a little bit inflated in terms of the 60%, especially in periods in which interest rates are pretty low. So let's start at the top with the U.S. dollar index. It's really interesting because it started trading in 1973. If you look on the internet, you can see some reconstituted versions that show the dollar peaked in late 1969 and declined aggressively when we went off the gold standard. And if you look at these reconstituted versions, they show from 69 to 80 significant decline, even worse than what you see here in this data in stock charts. So that's interesting to me. I wish we had more proper history we could look at there. So it is a little questionable. But I'm just getting to the point that if you look at the last two secular bear markets in stocks, the last one coincided with a big bear market in the U.S. dollar index. And, if we're looking at the reconstituted data, then we could say the last one, or the second to last one, that secular bear from 68 to 82 also coincided with a decline in the U.S. dollar index. So, simply put, that has been the big problem for gold in recent years, is that, we have the dollar strength as one issue, but also the U.S. stock market has not fallen into a secular bear market yet. And again, the real key for that following over the months ahead will be, does the market fall below its 40-month moving average? And folks, that's exactly where the market bottomed in June, right around 3,600, in the low 3,600s. So if the secular bull market in stocks is going to continue, which I really doubt, then we've already hit the low for this bear market. So in that scenario, what happens? The scenario where the market rolls over, based on that indicator, it's now in a secular bear. We can look at what happened. You can look at those yellow boxes there, and the blue lines show when the Fed started easing policy. That was rate cuts, I believe, at the very start of 1970 or the end of 69, and then you had in early 2001, and then also in late 1929, after the stock market crashed, you had the Fed was easing policy in a number of ways. And so that's really, if we look at the catalyst after the start of the last two secular bears, that was around roughly 12 months If I'm remembering correctly, roughly a year after the bear market started, that's when the Fed started easing policy. Around that time, you had gold or gold stocks start to move. So that's what we're looking for over the coming months. And getting down to the gold against the S&P 500 ratio, that just reflects the fact that gold hasn't been in a real bull market. Gold has not been in a secular bull market yet. The secular bull market in gold, and you can tell by looking at the gold to S&P 500 ratio, that's not going to start. It's not going to be confirmed that it has started until you see gold break out and go above 2,100. So, if we go to the bottom, the 60-40 expected returns, we can see obviously when expected returns are really, really low, those are the times when secular bears in stocks can start, and when secular bulls in gold can start. And if you look at the biggest moves in gold and gold stocks, like let's talk about gold stocks, the biggest moves beyond just a 1 or 2 year basis, I think there's been about a handful of them. You go back, you have 1929 or 1931, depending on which index you're looking at, to 35, 37, 38, depending on the index. So that was a huge move for gold stocks, secular bear market. You look at, you have the 76 to 80 period. You have the mid 70s when we had the early to mid 70s recession, the 73 to 74 period. Gold diverged the entire time. Gold stocks as well, they had a huge move. So those are three. And then also we have in the 2000s, the 2001 to 2000. I mean, you could say the whole thing, 2001 to 2011, or you can say 01 to 07, and then late 08 into 2011. So those were during secular bears. And then the one chink in the armor for all this analysis, you could say that's, and I'm not showing the gold stocks here, but the gold stocks in the mid 60s, 64, 65, that's when they started a huge breakout. They broke out above their high in the mid 30s. So that was a massive historic breakout in the gold market, 64 to 65. So gold stocks did have a really big move from 64 up to 68. It was moving with the market. So you don't see that on this ratio here because, of course, the gold price was fixed. But look, that was a period when the S&P actually made new highs and gold stocks broke out and made new highs at the same time. So, is that a little chink in all this analysis, in the armor of all this analysis? I mean, yeah, you could say possibly. But the S&P, I mean, remember, 1966, that's when the Dow peaked. And if you look at the S&P there from 64, 65 up to 68, it really didn't rise that much. I mean, it was only a modest rise to higher highs. And so the gold stocks were strongly outperforming after 1964. They were strongly outperforming the market. So I don't know. I mean, it's definitely possible in nominal terms that after this bear market, the S&P, it can make a new high like it did in 1973 or like it did in 68. I mean, I guess that's possible, but again, if the S&P falls well below the 40-month moving average, that's more significant than later on if it makes a new nominal high. And so if the S&P, I guess what I'm getting at, in real terms, I don't see, how the in real terms, how the secular bull in stocks is going to continue. And so that, that puts us in the mid 60s or 1968, depending on how you measure it. So, this is all what we have to look forward to in the coming months. It's going to be really significant. Does the S&P lose the 40-month and make a lower low, fall into a secular bear? We have that. And then also the U.S. dollar index. I mean, maybe that is going to make, potentially a huge peak in the next 6 to 12 months, and that would be very significant for precious metals and commodities, obviously. But remember, gold leads at key turning points. So the scope of the rebound in gold and that kind of move. If gold has a huge move coming off this bottom when they ease policy, if gold has a huge move and breaks out, that's probably telling you that the dollar will fall into a secular bear or a real significant bear market like it did in the early 70s and early 2000s. Okay, that's all for this video. That was quite a lot to take in. I'm sorry for all the ongoing babbling. Let me know what you think in the comments. Follow all my work at TheDailyGold.com and here on the channel. Really appreciate it, and I'll see you in the next video.